Oh, welcome to Banknado. Remember that show that was movies they were doing there, Sharknado? The sharks were up in a tornado and they were getting dropped all over the place. That was a thing for a while. They made a few of those movies, if I'm not mistaken. Anyway, welcome to Banknado. Well, we can guide you here at the WatchDog on Wall Street show. We can guide you through all of this Banknado nonsense because, again, we don't subscribe to the powers that be, their bull excrement. We don't do that. And we're critical thinkers here. Okay. And that's what we'd like you to become as well. All right. Stories coming out. Basically, echo chamber of what we've been talking about here. How bank oversight failed. The economy changed. Regulators didn't. Why? Why didn't the regulators change? Why? Yeah, people, let me give an example. This is not having to do with a bank. I had to travel this past weekend, and there I am again, trying to get through TSA. And I'm watching. I'm watching just how slow everything is moving. You got all of these TSA agents standing around, not doing a damn thing. Got these high-tech machines there that they're looking through, and the white lady behind our line was so slow. I mean, it backed up. The thing was barely moving, and there's no thought process into what we're doing. The rules were written, and they don't get rid of stupid regulations. It's not like we have any critical thinkers there, people able to actually use their mind to solve a problem, and they just add more. But what was the latest one? Peanut butter now, people. Peanut butter is now considered a liquid. Don't bring peanut butter onto planes. Now, again, I wouldn't be bringing peanut butter, but, come to think of it, when the kids were younger, my wife might have. Are you serious? But this is the same everywhere when it comes to government. We in this country, it's unfortunate. It's a failure of our educational system. We don't teach people to solve problems. We don't teach people to be critical thinkers. We teach people to just shut the hell up, run the machine, and do what you're told. And this comes from a George Carlin skit many, many, many moons ago when he was making fun of education here in the United States. They don't want the last thing in the world. Last thing in the world that the powers that be want is for people to be critical thinkers. They don't want that. They don't want me questioning things out there. You're supposed to go right along. You're supposed to listen to the talking heads on the mainstream media, whatever they say, and it is what it is, and just pay attention and shut the hell up. People start becoming critical thinkers. They'll start actually taking a look at their lot in life and the position they're in and how things are. And guess what? There might be a bit of pushback, but we're not even close to that happening. The closest we got to that was, I have to say, it's probably electing Trump in 2016. However, I don't know what would have happened if the Democrats actually put up a viable candidate. We all know Hillary's likability isn't exactly through the roof. But yeah, again, we get the same people in charge, same people running the show, same people that are ruining everything. But anyway, how bank oversight failed, the economy changed, regulators didn't. Okay, interest rates going up. No kidding. Wow. I mean, that wasn't telegraphed or anything like that, right? I mean, the Fed hasn't been talking about it, hasn't been all over the news. But again, these banks there, they didn't pay attention to it. And guess what? The Fed didn't really, as part of their stress test, didn't even take that into consideration. But again, I put that in perspective. We got Dodd-Frank, where you were told everything is awesome. Government stepped in. We got banking regulations. Everything's great. Yet they don't even factor in interest rate risk in some of these stress tests. They talk about the nature of supervision. This goes to what I was just saying. Becoming more bureaucratic and process-oriented, just when banking was moving faster. Examiner raised problems with Silicon Valley Bank, but didn't escalate their concerns to formal enforcement actions until after a run on the bank started. What the hell good is that then? I mean, so what good is your tax dollars being spent on regulators if they're going to act like this? It's just no good. This is the same reason why, one of the reasons why I say I don't want to spend any money regulating cryptocurrencies. It's just going to, all it's going to do is give people a false sense of security. They're not going to stop anything. They're not going to deal with anything. The supervisory process has not evolved for rapid decision making. Your staff hasn't evolved for rapid decision making. It's focused on consistency over speed. This is from the former president of the Federal Reserve Bank of Boston. In a fast-moving situation, the system is not well designed to force change quickly. Then what good is the system? Because we all know things happen very, very quickly in the world that we live in today. Again, these people, they don't allow them to think. Okay, this is the Federal Reserve. They're still working on BS models that they came up with ages ago that make no sense. Funny, examiners, watch this. Examiners had found that Silicon Valley in 2019, there was problems with the bank's risk controls. Last summer, Fed warned about the flaws in liquidity and risk management and governance. But they weren't even put on Dean Wormer's double secret probation. The alerts came, they put out matters requiring attention and matters requiring immediate attention. So these are memos. These are memos or TPS reports if you're a fan of Office Space. Make sure you put your cover sheet on. They're putting these things out. And again, well, what does it do? Does it do anything? I mean, let's be honest, people. But the restaurant inspectors that come around to make sure that the people in the kitchen are not leaving the chicken out and too long and the temperatures are correct. They're much more stringent than these guys. It's a reality. Which leads us again to other things being thrown out there that we talked about as well, talking about social media and the ability for rumors to spread very quickly compared to the way things were in 2008. John Danielson, director of the Systemic Risk Center at the London School of Economics. Yeah, the increased use of the internet and social media, digital banking, all work to make the financial system more fragile than it already would be. Social media not only allows for rumors to spread more easily, but much faster. You guys are just coming to that realization now. Again, we mentioned it here on the program. Buddy Chuck Schumer forced to run on Indy Mac Bank back in 2008 in a letter that he wrote and took that bank out. That was Chuck Schumer. Today, all you need is a few well-placed people here, there, and everywhere starting rumors, yelling fire in a crowded theater, and guess what? Going to rush for the exits. This is the reality. And again, what I'm not hearing anybody talk about it, again, this has, in my opinion, national security implications. Your adversaries can cause runs on banks here in the United States. It's definitely a possibility, and it's something we need to consider and think about. Again, I don't have any problem if the FDIC wants to raise the threshold in regards to insurance. And quite honestly, I don't think many people would care. People who have larger deposits, if we had to pay a little bit more, whether there be an insurance to make sure that it's okay. Because again, it's quite frankly, it's ease of use. You got to do payroll, and you got to be taking payroll from a myriad of different bank accounts. That's a pain in the ass. Okay, it is. And listen, I like our accountants. I like to make their lives as easy as possible. Anyway, let's talk about Wall Street and all this. I actually looked up. I looked up the ratings. This is what the stock analysts had on Silicon Valley Bank. Okay, up until now, of course. Raymond James, outperform. Truist Financial, buy. Maxim, buy. Barclays, equal weight. Morgan Stanley, yay for you, underweight, but not a sell. JP Morgan Chase, overweight. Piper Sandler, neutral. Goldman Sachs, buy. Oppenheimer, outperform, market perform. UBS, neutral. All these banks, Bank of America, buy, which is Merrill Lynch. SunTrust, buy. Buy. What do these banking analysts do? I can tell you a story. It's taking me back to my younger years. I was a young pup there back in the 1990s, and I'm sitting in a meeting and I can't even remember exactly what the deal was for. And you had it was the retail analyst at the time from Goldman Sachs. And I was introduced to the retail analyst Goldman Sachs, who pedigree, white shoe guy. I don't know. His name was probably, I don't know, Stanford or I don't know. You know what I'm talking about. And he definitely had a few Roman numerals at the end of his name. Get my drift? Yeah. Okay. Talking to him, just having a conversation. I'm trying to have a conversation. Didn't really want to have much to do with me. Talking about Walmart, and I was just asking some questions, and I was throwing some things out there, and he seemed kind of puzzled. And yeah, the guy made the point. It was like, I've never stepped foot in a Walmart. And I'm saying, you what? You're the lead retail analyst over at Goldman Sachs, and you've never stepped foot in a Walmart? You're not going to go there to actually see how the operation works, try to get a feel for what's going on? No, I got their numbers and their models and all that stuff, and they're not going to look into anything like that. The guy probably rather be caught dead than going in a Walmart. Let me tell you how these big firms operate. And again, I've explained this before. Silicon Valley Bank was a pipeline of money. It was a spigot of cash. Spigot of cash for Wall Street and all of these firms. How was it a spigot of cash? Silicon Valley Bank did all of the banking. Well, not all, but was the primary banker for all of the darling Silicon Valley startups and had relationships with the venture capital companies. Now, all of these Wall Street firms, they want to get invited to the big dance. They want to go to the ball when a company has been sufficiently laddered up to a ridiculous valuation over a period of time. I don't care what it is. They want to get invited to that party when that company goes public. They want those investment banking fees. So let me ask you a quick question. Do you think Silicon Valley Bank is going to want to do business or give deals to Wall Street firms that have a sell on their stock? No frickin' way. No way. Again, they won't put it on paper anymore. They got caught back in the 1990s. But it's, wink, wink, nod, nod. Okay. This company can put a lot of money in all of our pockets, leave it. Don't even go to a hold. You want to go to an underweight? Fine. Okay. But no one puts a sell on this thing because we want the money. We want the cash. And again, this goes to the heart of the problem with the way Wall Street is set up, why the big banks are set up. They're not fiduciaries. They're not looking out for your best interests. The big banks are publicly traded. So to them, they've got to do the best thing by their shareholders. And if that means people losing money out there based upon their recommendations because they have a outperform or an underweight or a buy on Silicon Valley Bank, so be it. So be it. They don't give a rat's donkey about you. They want the investment banking fees. It's how it goes. It's how it's been going for a long period of time. We've discussed this. So no, you can't count on honest assessment from Wall Street firms. It's patently absurd. Let's talk a little bit about the Fed here. Neil Kashkari says stress in the banking sector brings the U.S. closer to recession. Yeah, we're still doing that Leonard Nimoy in search of recession, and you get all of these market experts. It's going to be in 2 months. It's going to be at the end of the year. Yeah, we might be in one right now. Dude, all due respect, okay? The 2008-2009 recession didn't get called a recession until like more than a year after it started by the NBER. Okay? We already had 2 quarters of negative economic growth last year, and they didn't call that a recession. So who knows what the hell they're going to call. None of this really matters, Neil. What matters is the fact that you nincompoops over at the Federal Reserve should all be fired. Period. You should have been fired over a year ago. We should have cleaned house. All of you didn't realize that there was inflation out there. You didn't go out and about. Your models didn't tell you that, huh? And these guys are supposed to be the best and the brightest, right? It's like a weatherman being outside and having it dumping on him, pouring rain, and him saying, "Oh, no, everything's sunny." You get rid of that guy, right? It's time. It's time to go, my friend. All of these people should go. Mary Daly over. You looking at the banks that are under stress right now? The California banks that are under all of these problems. What the hell are you doing there? What are you doing? I'm going to do another Office Space. Remember the Bobs? Ah, man, I love the Bobs from Office Space. That was great. The consultants that would come in. We need the Bobs. This country needs the Bobs in more ways than one. The Bobs need to be going into every aspect of government, zombie companies, you name it. We need a clean house. They need to go into the Fed. Yeah, you imagine a conversation between the Bobs and Mary Daly. What exactly do you say you do here? I mean, you got all of these banks that are falling apart on your watch. What are you doing here? You're putting out climate change ESG reports? Pretty much. So no, you can't count on the Fed. And again, you'll see them paraded all over TV because the pundits love. There's nothing than the pundits loving to kiss Fed ass. Oh, we got a good get. Hey, get this member of the Fed's coming on today. Oh boy, Neil Kashkari was on. Was he on Meet the Press or Face the Nation this weekend? Oh boy, that's a big get. Big get. In what way? Boy, what are you going to learn from these fools? Have you learned anything from these fools? Again, Federal Reserve breaking stuff since 1913. Okay. Banknado, more from Banknado. Companies, big and small, losing access to credit amid bank stress. Again, it's going to happen. Again, bond offerings have fallen off table. The IPO market is dead at this point in time. Many companies out there that have to roll over debt. They got to roll it over, are going to find themselves in a precarious position. They're going to find themselves in a precarious position because the debt, when they roll it over, they're going to be paying a hell of a lot more in interest. Whoops. Now what? Well, you might have to start, again, furthering layoffs, cutting costs, or you just might not make it. Okay? And again, many of these companies, if you need to revolve constantly on revolving debt all the time, well, I'm just saying, it better be a small portion of what you're doing. Today, again, more bank stories. The Banknado. First Citizens, which is a Raleigh, North Carolina bank, part of that what is it called there? The research triangle there with all those great universities. They're acquiring all of Silicon Valley's bank deposits, loans, and branches. 119 billion in deposits, 72 billion of loans at a discount. Some 90 billion of Silicon Valley Bank securities will remain in receivership. They got a pretty good deal. They got a great deal. You take a look at their stock prices at this point in time, skyrocketing. It was First Citizens was the 30th largest bank as of December 31st. It's going to put it in the top 25 after this deal. And again, clean up on aisle 7. The FDIC agreed to share any of First Citizens' losses or potential gains on SVB's commercial loans. The FDIC estimated the failure of SVB would cost the federal insurance fund it oversees about $20 billion, which is 10% of the bank's assets. Okay. I mean, again, this is First Citizens, a pretty well-run bank. Pretty conservative in the way that they do things because guess what? That's how banks are supposed to be. They're supposed to be conservative. They're not supposed to be taking ridiculous risks. Actually, Friday, busy day. And I didn't get a chance to do any podcasts on Friday. But I had mornings with Maria. And again, I brought it up on the show. I said, make banking boring again. Make banking boring again. We got to go back to boring banks. There was nothing wrong. I've been talking about this since they repealed it. Graham Leach, Wiley, which broke up Glass-Steagall. Give us Glass-Steagall, which is about 40 pages of regulation. Get rid of Sarbanes-Oxley. Get rid of Dodd-Frank, which is about, all in all, probably about 6,000 pages of regulation. You want to be a commercial bank, you're a commercial bank. You want to be an investment bank, you be an investment bank. And I don't care. Commercial bank, let them be boring. Giving out toasters for new accounts. Wouldn't be running into these problems, for crying out loud. Anyway, quickly on this. Again, this is a part of Sharknado as well. Banknado. First Republic Bank founder earned a big payday, as did his family members. You take a look at the pay packages that this Herbert fella received. His family received millions upon millions upon millions of dollars, well above the average. I mean, his pay package is like 1.5% of profit. I mean, usually for the CEO of a bank, it's less than 0.5%. Not to mention, he's got all of his relatives there making millions of dollars as well. Again, that might be something that, quite frankly, that maybe the Wall Street analysts should have pointed out and said something's not right. This is wrong. See, these people don't do their job. They don't do their job. They don't. Your job as an analyst of a company is to take it apart and to find the warts, the moles, the flaws out there, because again, it makes for a more solid company. You want to expose all of that, but that's not how it is. How it is, it's a relationship. The banking analysts, they have relationships with these companies that they cover, and quite frankly, the firms that these banking analysts work for, and it's not just banking, it's all these industries. They want to do deals with these companies. They want to do, again, where's the money? They want it, if they have the bond offering needs to be done, whatever it may be. That's big business. And you lose out on that business if your analysts are actually being honest and exposing the problems that these companies have. Yes, you can't trust this crap. You can't. Again, I've been saying this for years and years and years. For the life of me. I don't know why anybody in their right mind, again, I have no problem with some of these big banks and the safety that goes along with them, but to let them manage your money, you're going to listen to them when it comes to investment advice? Do you honestly think that they give a shit about you? They might give a shit about you if you're a big guy. Hey, you got a serious account there. You're getting up in the 10s, 20s, 50, 100 million. You're going to be all right. They're going to take care of you. They get that. Everybody else? Come on. No. You're just a number. That's all. Anyway, WatchDogOnWallStreet.com is our site. WatchDogOnWallStreet.com. Have a great day.